Welcome back, guys, to another roundtable. My name is Adam. With me, I have Rusmin and
Hi.
Victor.
Hi, everyone.
Thank you so much for joining us. And today we're going to talk about REITs and interest rates. So we know interest rates are going up everywhere. And we've covered interest rates before and compared them to what happens when interest rates goes up and what happens to bank stocks. So on the previous roundtable as well. So if you want to check out how interest rates affect Singapore banks specifically, we've done a roundtable on that. But today we're going to talk about REITs and how interest rates actually affect REITs since interest rates are going up. So what happens? How do interest rates affect REITs?
So when interest rate goes up, usually the borrowing costs will go up, right? So that's actually in theory. So let me give you an example. Let's say you own a property, right? That property is valued at $1 million. Let's say you buy that property at $1 million and you rent it out for $50,000 a year. And assuming you fully loan, right? You fully take loan from the bank to buy the property. Of course, in reality, you can't do that. But let's keep it simple, and there's no other expenses.
Mm-hmm.
So you're just having this one item where there's a rental income. The next line item is actually your expenses, right? Which is your borrowing cost.
Mm-hmm.
And this borrowing cost, of course, you borrow from the bank, and let's say at the interest rate of 1% a year, so that you are paying about $10,000 a year, right? So your $50,000 rental income minus your interest cost, that's going to have a net rental income of around $40,000, right? So if interest rate goes up to 2%, then of course your take-home return for net rental income is going to be ended up with $30,000, right?
So because your cost of borrowings go up.
Yeah,
right?
Yes. So that's the reason why I think every time when the Fed announce that they're going to increase the rate, the borrowing cost goes up, and market generally will price the REIT prices lower.
Mm-hmm.
Yeah. So that is in theory, right?
Okay.
And, yeah.
So that's the expected correlation. There's a negative correlation between interest rates and REIT prices.
Yes.
So when interest rates go up, people expect REITs to
prices
come down because
right.
the cost will go up. Yeah. And REITs are leverage instruments. They will always have some amount of debt on their portfolio to buy properties and all that stuff.
Even if you have cash, you won't pay down
you don't
fully.
You're going to utilize some amount of debt.
Oh, yes, yeah.
So naturally, the cost of borrowings will go up, and that will push the profit down. Yeah. And your distributions down as well.
Yeah, that's in theory.
In theory, right? So we want to find out whether that's actually true. So we've again done the research, and we're going to track some of the REITs that we have in Singapore that have a long history of being listed here, and compared them with the US Fed fund rates. Because anyway, the Fed fund rate affects our interest rates here in Singapore as well. All right, so we're going to pull out the chart right now. And you can see this is over the last 20 years. And we have 5 REITs over here. So Capital Land, Integrated Commercial Trust, Parkway Life, Ascendus, Mapletree Commercial, and Mapletree Industrial. So straight away, you can start to see there is some sort of correlation, but is it exactly negative? What do you see over here?
Yeah, I think we are actually looking at, let's say the long-term performance of this is the interest rate, all in all, is basically at almost zero level. Interest rate is going up recently, but if you look at the correlation, I think prices also goes up when interest rate goes up.
Yeah, so this is the interesting thing, because the accepted wisdom is that when interest rates go up, REITs come down. But based on the chart that we see over here, when interest rates have gone up, some of the REIT prices actually have gone up as well. Yeah. So the question is...
And of course, we need to put things into context. This is a long-term performance, right? And it's not even inclusive of the dividends that they have received, right?
This is just purely the unit prices. Yeah. So this is in Singapore. Yep. So I believe there's similar research that's done in the US as well.
Yes, correct. So I have this data over here, I think done by S&P Global. So what happened is that because the US have a very, very long history in terms of the REITs market. So they have all the way until back in 1976, right? So they have experienced, I think, 6 rising interest rate environment. So out of the 6, right, 4 of the period, the REITs actually did very well. And in fact, they actually beat the S&P 500 during that point of time when interest rate increased. So there was 2 periods that the REITs actually turned negative. But that is based on cumulative returns. So if you were to add back the dividends, right, except 1 year, most of the year are positive, right? But that's only that one particular year. But subsequent years, the REITs perform after the interest rate increase. So I think generally based on the history of US, we can see sort of a similar situation which may happen in Singapore REITs too, right? So I think the 1 year, the 2 years particular decrease is because when there's a sudden change in interest rate, right, usually the REITs will hurt, or I say it's high volatility for a short period of time. But after when the dust settle, they tend to perform. And that's what happened in 2013, where they actually start to taper down the QE, and the REITs actually become volatile for that one particular, and after that eventually they perform. Yeah.
All right. So even in the US, the data seems to show that there's a positive correlation rather than a negative correlation.
Yeah.
So in the Singapore charts and the US charts, when interest rates go up, the REITs prices have gone up as well.
Yeah.
Yes, yeah.
So how come? So the question is, right, everyone's watching this. What's happening? Because the accepted wisdom is the other way around. So why are prices going up?
Okay, so when it typically in the environment where interest rate going up, it's also a sign that economy is actually doing well, right? So when economies are doing well, businesses are also doing well, right? And consumers are also, as businesses are doing well, they are paying the employees more. Employees are also doing well. So from both businesses and the consumers' point of view, they are both doing well, and that will actually lead to the demand for more office space, expansion for businesses, and they also will look out for more warehouses, logistic, and all that. And consumer, of course, will spend more at the retail shop. They will also start to travel more, and that will actually benefit the hospitality, right? So if you look at the best example, will be in between 2004 and 2007, and where the Fed fund rate actually gone up from below 1%. To as high as 5% at a point of time. Okay, and if you look at the Singapore rental index in the same period between 2004 2007, it has actually gone up across the office rental index, shop rental index, industrial rental index, and hotel revenue per available room also has gone up during those periods. Okay, and because of that, the REITs were able to charge a higher rent, okay? And as they charge higher rent, they can actually pass on this incremental cost of borrowing cost, so-called, to the tenants, right? And that actually leads to expansion of the distribution per unit, right? And you can see at the time, I think there were only few limited number of REITs were listed at the point of time. The first one was CapitaLand Mall Trust, and then followed by Ascenders, and then Mapletree Logistics along the way, okay? But so if you look at the CapitaLand and Ascenders, these two were the oldest REITs around, right, since 2003 and 2004. Their DPU performance between 2003 to 2007 actually has grown at a single digit on a year-to-year basis. And that leads to the price expansion for the REIT sector in Singapore. And in fact, in the 2004 itself, the prices for REITs had appreciated by 30%. And then 2005, it also appreciated by 13%, followed by 2006, appreciated by 40%. But of course, 2007, 2008, that is where the things started to turn, when Lehman Brothers was started to
that was the global crisis, financial crisis, right?
Yeah. So this increment is kind of like, it defies your understanding of the higher interest rate supposed to impact your borrowing cost, but we are looking at it from the higher rental point of view, not just.
I mean, it's a more holistic picture, right? Because when you just say interest rates go up, REITs come down, you're just using one layer of analysis, and that's just it. It's black and white. But when you invest, there's so many other things to consider. So when interest rates go up, there is a reason why it's going up, and usually it's because the economy is like overheating in a sense, and that's why they want to raise interest rates. And if economy is doing well, like you said, then businesses are doing well, consumers are spending.
Yes.
Then the REITs can raise their rents.
Yes.
Correct. So that's what you're saying.
Yeah. In the way, if you look at the recent, COVID easing, regulation and all that, I think the whole world is actually expecting a recovery in that sense. So the Fed is also trying to raise the rate to, curb the inflation, right? That's why they always say that inflation typically leads to asset inflation. And this is good for if you invest in property or invest in equity, right? So over the long run.
So to summarize, basically, when interest rates are going up, you're just saying the economy is typically doing well, and then REITs will do well as well. Then the DPUs will go up, share prices should go up. Yeah. And, even though, yes, it's true, when interest rates go up, it's a bad thing in a sense because the cost of debt
will go up.
Will go up. It's more expensive.
Yeah.
But that's offset by a better performing economy most of the time.
Yeah. So I mean, the past 10 years, I think we have 4, 5, 6 occasions where Fed trying to announce they're going to increase the interest rate, and the market started to sell down a lot of REITs in Singapore. So there was a time where I think it was becoming very attractive to actually look at REITs.
I remember doing that. We were like looking at all these mini opportunities, right? Exactly.
I think it happens 2 times in the past 10 years.
Yeah,
Yeah.
quite. I think more than that actually. So this is something where I think the market stands to be short-sighted, because if the Fed increase the rate, people will start to, a lot of uncertainties hanging around, right? People will start to sell and dump their shares, especially if they see the share price crashing down. They also panic. They also sell down. Yeah.
So it does maybe hold true maybe in the very short term when there's a little, like you said, a little
Yep.
bit of volatility
Short-
when
Yeah.
the
I think investor just can't take the sudden increase in interest rate, right? So they
Some
scared, they just
investors.
sell. Yeah.
so there's some volatility
Yeah.
in that near term because of people are just trying to price in that rate hike.
Yeah.
Yep.
So I mean, of course, having said that, the REITs in Singapore have not gone through the period where the interest rate were as high as 9%, 8% during the 1998. Before the Asian financial crisis, those period, I think we do not know how they're going to perform, but overall, I think it will be net negative impact.
But in fact,
Yeah.
if you look at the US during the 1976 to 1980, right, that was the period where the inflation was very high. In fact, that was one of the top performance for the REITs during that point of time for the US REITs.
So
right?
this brings back the point where inflation is good. Higher interest rate is also good for if you own the asset.
If you're an asset owner. Right?
Owner, yes. Yeah.
Okay. So I think we've established the fact that it's not true that interest rates negatively correlate with REIT performance. That's not entirely true. In fact, it seems to point the other way based on the data that we have. And we've explained why that's the case, because of the economy doing well and the REITs raising prices and all that. So if you know that information, would you just say, okay, so since interest rates are going up, should I just go out there and just buy any REIT I can get my hands on? Does it work that way?
No, not all REITs are equal.
Alright. So what should you still look out for in a rising interest rate environment?
I mean, we can spend another day talking about what you should look out for, right? But in summary, I think the things that you should be looking at, of course, the quality assets that the REITs own. You want to invest in those quality. Let's say it's the office. You want to invest those offices located in the prime location, especially in the CBD district of Singapore. Let's say looking at Singapore area. But if you go outside of Singapore, of course, the condition may be different, right? So each market can be very different when it comes to property. So the same thing for retail. The criteria is very important. You want to be in those prime locations.
Because prime location have more pricing power, so it's easy for them to pass down the rent.
And there's limited supply, especially in Singapore as well. Right?
Yes. So other categories like industrial or offices, I mean, they may also subject to, like what you say, supply and demand. So that also depends on how many supply are coming up. If there's oversupply situation like what we see in actually KL, of course, we will see a lot of pressure in terms of rental. It may not recover even though economy expand, economy is doing well, the rental will just stuck there. So property at the end of the day will still boils down to supply and demand kind of issue. But in Singapore, I think it's managed quite well by URA. So those are the area where you need to consider before you actually invest in that. And of course, on top of that, there are other qualitative aspects like your management track record, and sponsors, and of course the financial part is more important, more relevant when it comes to higher interest rate. You want to pay attention to those REITs that have reasonable gearing. Okay, of course nowadays we have regulatory limit of 50% for the REITs in Singapore. So nowadays the REITs are gearing up even more because of that limit. Okay, but in the past used to be limited to 45%. But personally, I still more comfortable to invest in those REITs that have like 40% or less. Okay, so those are the things that you need to consider. Of course, the other things that you can look at, of course, the interest rate, interest coverage ratio. And generally, if you look at interest coverage ratio, you want to be higher the better. Okay, so minimum benchmark is, of course, is more than 3 times. And of course, you also want to look at the loans itself. Some of the REITs that they borrow money, you want to see whether majority of it are actually floating or fixed. Because in the rising rate environment, floating loans may subject to more pressure in the short term. Because REITs typically they agree the rental rate with the tenant for 2 years, 3 years, so they may not raise the rate as quickly as compared to interest rate rises, right? So that is the main risk for those REITs that have a lot of their loans are floating in nature.
The fixed rate just gives you a bit more stability.
Because they're already paying at a higher interest rate already.
Correct.
So if the interest rate were to go up,
it's kind of like
your distribution per unit won't be affected that much, right?
Okay.
And of course, those long fixed loan, right? For a longer fixed loan, right? I mean, they will feel the pressure over a long run, but it will be slower as compared to those that are floating in nature and short term.
But it gives you visibility. So if it gives you visibility, the REIT can actually plan ahead and manage the capital accordingly, rather than being surprised by a sudden jump and all that, and then they have to start scrambling.
Yeah.
You know, it's a totally different thing.
Yeah. And of course, you also want to look at some of the REITs, their loans, their maturity profile, because I've seen some newer REITs, higher risk, like Sasa or Tasin Retail Trust. This is not a REIT, but it's actually a business trust, but it's comparable to a REIT because most of their properties are actually a REITs and they pay out 100% of their distributable income. So if you look at their debt maturity profile, I think most of it is going to mature in 2022. Most of their loans. Okay, typically when you look at the REITs, you want to have a well staggered maturity, right? So in 1 year, the management don't need to have so much stress to refinance this particular loan. Just imagine, let's say 2022 is another down year, crisis, right? It could be a big problem to refinance some of these major loans that are due all of a sudden in one particular year. Okay, that put a lot of stress, and that actually can be a high risk investment. If they can't refinance a loan, then they may have to go for equity fundraising and all that, which can be very dilutive in nature. Yeah.
Yep. So it sounds that there are macro and micro factors to take into consideration when you're looking to invest into a REIT. So despite rising interest rates, the macro factors will play a role.
Yes.
Supply, demand,
and
quality
of the assets.
Quality of assets. Yeah. So and then of course the economy just doing well overall.
Yeah.
So and then of course the micro factors, basically the quality of the assets, will basically affect your demand. Because if you have a popular mall that you need to be there, the rents can stay up or even go up during in this environment.
Yeah.
And then of course, like you said, all the debt capital management strategies that you have in place.
Yes.
Very, very important.
And of course the valuation, right? So you want to get it at a good price. So that's something where you don't just buy because everyone is buying. You don't just sell because everyone is selling.
So I think there's a whole host of things that you need to do when you want to invest in REITs. We're not going to cover them today because it's really, like you said, so many things to cover.
Yeah.
In fact, we run a full course on this to actually explain REITs, so we can't do this in one simple roundtable. But we wanted to explore the relationship between interest rates and the performance of REITs, and whether the saying where interest rates go up and REITs come down is actually true. So we actually want to go find out, and it's actually not so true.
So previously we mentioned that you can actually hedge your REITs against the bank, because banks are supposed to have the positive correlation with interest rate. REITs supposed to have negative correlation, but in this case, I think we are looking at both have positive correlation with interest rate.
So if you go back to our previous roundtable on banks, there is a positive correlation between interest rates and banks. That one's pretty clear. But in terms of REITs, it seems that it's positive as well. So actually,
but there's a short period where you'll drop.
There's some
pressure.
In fact, I think we've seen REITs come down a little bit recently, right?
Yes.
At this point, I was just recording, come down a little bit because of this
interest rate
volatility and all that. Yeah, but I think we have still to look at the long-term factors and the fundamentals of the REITs when you want to invest in them. And of course, all the factors that we've discussed today will come into play and not just interest rates per se. Right. Okay, so I think that's a pretty good wrap-up on this roundtable. So, if you're a dividend investor and you love REITs and you're worried about interest rates at this point in time, I hope this gave you a little bit of information about how interest rates actually affect REITs historically. All right, so once again, my name is Adam and that's Rusmin.
Thank you.
And that's Victor.
Thank you.
Thank you so much for joining us. And if you like this roundtable, please hit the like button. Tell us we're doing a great job. Any questions about REITs, put them in the comment section. And of course, subscribe to our channel. Many more roundtables coming up again. So see you around.